Annuities. Today we are doing a bit of a deep dive around annuities. A lot of people have heard of them. Many people have them. But we're going to talk about the case for annuities, the why, the how, the when, the why, the who've already said that. But all that to say, I am joined again in the studio by financial advisor to the stars, Nathan Fradley. Welcome back to Retire Right.
Thank you, Glenn. I don't know about the stars, but...
Well, I don't know. Plastic surgeon to the stars, like high-profile stuff.
Yeah. Well, if I was financial advisor to the stars, I couldn't tell you because of privacy. So.
Exactly. There you go. But look, we're going to talk about annuities. We've put together a slide deck, and I'm going to get Nathan to go through them. If you are a listener of the show and not just visual here on YouTube, that's fine. You won't be left behind, but just letting you know that the accompanying slides may help, and they just keep us on track here in the studio. But right now, my name is Glen James, and you are listening to Retire Right.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Okay, Nathan, I will turn over to you. What are annuities?
Firstly, I got to say, you know when you're like driving a friend's car and you're really nervous about it because it's their car and you haven't... That's what I feel like driving the iPad today. So wish me luck, everyone, and bear with me. Annuities can be a lot of things, and I think the term annuity gets conflated with what we're talking about today. And there are different types of annuities. What we're going to talk today about are what we call liquid lifetime annuities.
Right.
And they have really specific rules associated with them that grant the person who holds it some Centrelink concessions.
So, and you may get into it, but was there a reason why that they are advantageous for Centrelink? Had you planned to cover the why behind it, or just the fact that they are? No.
We'll definitely talk through kind of the why in the sense of there was an encouragement by the government to. No, it was more of a fear by the government that people were spending their super too quickly.
Right. So it's okay. So it was an incentive because of the fear.
Yeah. People were turning 65 and ripping their money out of super and relying on the age pension, and the government's looking at these numbers and going, well, this system was supposed to ensure that they didn't rely on the age pension as much, but also that we had some level of longevity. And not that they'd ever say the age pension is not enough to live on, but they kind of went, we need to install some encouragement to get people to buy, in this instance, income for life so that they've got a little bit of a higher standard of living, and therefore there's less reliance on, I suppose, social security and the rest of it.
Yeah, cool. So you're effectively buying an income stream with your money.
Yeah. And they went so far in the changes to actually all super funds need to have an offering of this and are working on it at the moment so that there is an option to, within your super fund, not having to go external to do something like this.
I mean, my mind boggles how they could do that with the current unitized funds, but we know in, the Grattan think tank, they did the big report last year, and they were pretty much saying, we think there is a case for most people to have most of their money in an annuity, one, to remove the market timing and people trying to do stuff themselves who aren't maybe financially literate enough to understand that, no, you don't want to buy when it's high and sell when it's low and all that stuff. So I think there is a case for them, but we haven't seen them as yet in super funds.
No, one or two have released some. They're trying to be a bit more creative with them and do something that we're going to see that come out more and more and more. And it's interesting, like that Grattan report and even just anecdotally talking to people who use them, it's usually a portion of your assets, but a smaller portion, 20, 30% for those that do them. And I find that really interesting because everyone knows someone who worked at the government who ended up with a defined benefit, or some of the old police force ones, and
many of our listeners do have defined benefits still.
And the people are envious of them. Like, you get guaranteed income for the rest of your life. How good is that? But when we have the opportunity to do it, there can be some hesitation because I'm losing some liquidity or whatever it might be. And we'll talk through that today.
Yeah, cool.
So bring it back in. There is this concession for Centrelink, and we'll cover that in a bit more detail. And then you can use super and non-super money. You can set them up with reversionary benefits as well, which means that if the person who holds it passes away, it just moves to their partner without having to close it and reopen it, and there's no interruption of payments. And there's a few details behind the scenes in all of this. As you said, what are we doing? We're buying income. We're buying income for life.
So we're basically swapping our big lump sum of money or a lump sum of money, putting that money in an annuity provider. They effectively invest it, try and make a little bit more money so they can have a business, and tell us that, we'll guarantee for the term of your life that you'll get X amount per month spat back out.
Correct. Yeah. So you invest that money. The companies that do these are life insurers. So the super funds might do it themselves, but they might also, to go to an external life insurance company to underwrite it. And you're right. They invest that money, but they do have some restrictions of what they can do with it. They've got really, really tight capital regulations. They can only invest in things like bonds and commercial property. They're not putting it in high-risk portfolios or anything like that. But that's the effect. And you get this income, which is one part interest and one part returning the capital. And we look at the case study a bit later. When you look at the percentage income you're getting, it seems really attractive, but it's because you're drawing down on that capital. And I think that's a key part. And so I suppose the only other thing on this slide, for those of you listening in, one of the common misconceptions with annuities is that you buy this income for life and you get nothing back. So if you pass away too soon, as we all pass away too soon, I guess, Glenn, but if you pass away too soon, there's kind of a risk, like you're gambling with it. And that exists because they used to work like that. You used to buy it and you'd get the income, but there was no residual. But with the new ones, the way it works, we mentioned you're drawing down on capital, and I'll show you what it looks like in a second. You do get that money back.
But not always, because obviously there are different products, right? So like if I log in with my insurance company, with my car insurance, it will have, okay, do you want the window repair stone chip option, windscreen? Yep. Do I want higher car option? Yep. Do you want higher or lower excess? Yep. Those options tweak the premium, right? So I think what I'm trying to help explain is if you rocked up with $1 million or $500,000, if you tick the option that I want it to be linked to CPI forever, or tick the option I want money to be left over to my spouse when I die, or to my estate, or reversionary, those tick boxes, we'll call them add-ons, may reduce the buying power of your capital.
Correct, yes. But in order for this to be a liquid lifetime annuity, by definition, and to get those concessions, there's certain things they have to have. And so if we draw it out, what it looks like over time is we've got our time chart here and we've got our dollars here. Your income, what you're getting from this liquid lifetime annuity, stays the same. Now, as Glenn mentioned, maybe it's linked with CPI and things like that, but you're guaranteed this income. So that's your income there. Your balance coming in decreases over time. So that has to be a feature of, in order for it to meet the requirements for this product, you have to have some residual balance.
Because it's returning some of your capital.
Correct, yeah. So it's not a case of you buy it and you pass away 12 months later, too bad. That capital drawdown is what you're seeing. Each time you get a payment, you'll get some interest and some capital, and the balance goes down. How fast it goes down depends on how old you are when you go in. But it might be, let's say it takes 18 years for that to happen. If you pass away before that point, you would get the residual balance left unless, as you mentioned, you've ticked the box on the application, you've taken the feature for a guaranteed death benefit. And that might say, if you pass away in the first 9 years, we'll give you all your money back. But beyond that point, it would just reset.
You've paid for it, aka the insurance policy, you've paid for that by way of, well, to get your income, target income from that annuity, you're going to have to put more capital in or have a trade-off of this tack-on with Fry's feature of less income but the guarantee that some money comes back or...
100%. Yeah, that's exactly right. So if you've got no reason for that to be, you don't need the death benefit, you got no beneficiaries, whatever it might be, then you'll get a slightly better payment, right? So that's in effect the basics, and that specific shape diagram is the one that the government uses. So that's when they were designed, that's the shape. So you do get that money back.
So talk to us about the Centrelink concessions.
So this is the encouragement piece, right? This is the carrot, for want of a better term. The value of an annuity is discounted when they're calculating your Centrelink benefits. So let's say you put $300,000 in because the maths is easy on that. 60% of that would be assessed, as opposed to $300,000 of it, and that's before you turn. The year you turn 85, it's a little complicated, but the year on your anniversary you turn 85, that's when it changes to 30%. So it's based off the original value. It's not the decreased value over time. If you put $100,000 in now, Centrelink say you've got $60,000. When you turn the year you're going to turn 85, Centrelink say you've only got $30,000. And that, for people who are in that part pension area, can create an uplift that makes a lot of benefit. If you're on a full pension, doesn't really matter. And the same applies to the income test. So the income that you're getting, because it's the way it's worked on deeming, it works the same way. So if you're income tested, you're still getting that discount.
Yeah, and it's really important to reiterate, you see so much online where you need X amount of money to retire in Australia, or you need to have $1 million in super, or dollar figure this, dollar figure that. You can't look at it that way. You need to work back with, like, the retirement number isn't a capital amount in your super. Your retirement number is how much do we need to live on per week after tax. That's your retirement number. Then we back work it, backflow it, or whatever you call it, back engineer it.
Reverse engineering?
Reverse, that will do. It's been a long life, long day.
Well, you've been driving the car today, so the car metaphor's coming in.
Yeah, so, and it could be, well, okay, between the 2 or 3 of our super funds, between the two of us, we might have $1 million, might not. We might have some other assets. And then you just kind of layer the income to arrive at your weekly amount to live off or fortnightly amount to live off. Could be from an annuity. And I know you've got a slide coming that shows some layering. It could be from rental income from a property. There could be some age pension benefits. There could be some income streams. So I just wanted to jump in there and just remind everyone that your retirement number isn't a lump sum in super. It is how much do you need per week, and then how do we set up our financial plan in order to make sure whatever's happening in the market, whatever's happening out there in money land, you have $1,200, $1,000, $2,000, whatever your amount is, rock up in your bank account every week.
100%.
And an annuity will help that happen on a guaranteed basis and pick up some Centrelink concessions along the way.
Yeah. And the idea is that you get more Centrelink for the same amount of money, so your money becomes more efficient if you're in that part pension zone. But we're starting with the question of how much do we need to live on, not how much do we have.
Yeah.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, let's look at some actual practical numbers when it comes to an annuity and how much buys how much per month. Okay, so what have you got there, my friend?
So I think a really important thing to note is the day we've recorded this and the day you're watching it, these numbers are different.
Okay.
So the number that the annuity pays changes by the way the cash rate is moving and the yield curve. So it's not just whether or not there was a change, it's expected changes. And so there is a bit of a timing aspect that you can't really control.
So for example, when we're going through COVID and interest rates are 1%, there's probably not a big reason on the planet to throw your money and lock it into an annuity.
Correct.
Potentially.
Yeah,
and
there was a lot less reason to do so.
That's right. That's probably more so. But as interest rates are higher than it was back then, it could be more compelling to – it's the inverse of a fixed variable mortgage really, isn't it?
Yeah. When you get in is the rate you're going to get. And I've heard of – we talked about defined benefits before.
Yeah.
There was one of the defined benefit offerings that a lot of people decided to take up and retire early because they could move all of the money into the annuity, get a guaranteed reversionary benefit for their spouse that they didn't get through the defined benefit, and get more money for life.
Yeah.
So it's an interesting – that was a timing thing though. It was a sweet spot.
And you don't want to, live in agony working on timing, but you just need to know –
be aware.
If you go and get an advice document tomorrow and they've recommended an annuity and you sit on it for 6 months and go back, we want to execute this now, the numbers might be different.
Yeah. Yeah. You can't walk in and go, I saw on Retire Right I can get $24,000 but the time it takes them to fund it, it could have changed.
That's right.
I think that's important.
Okay, so what have we got here?
So
Natalie and Ian.
Natalie and Ian, both 67, homeowners. Okay. In this instance, we're going to take out an annuity. We're going to use 30%. 30% is kind of like my rule of thumb that I start from. It's a bit of a sweet spot in terms of enough money for an uplift to make a difference, but it really depends.
So, okay, wait. You're going to use 30% of the super balance in an annuity.
Yeah.
Okay, cool.
So they got $1 million in super. We're going to use 30%, rounded for ease of calculation's sake.
And me as the protagonist. Was that the
antagonist?
Antagonist, sorry. I'm getting my agonists wrong.
You got it backwards? Reversed.
Just as a sidebar for this, you're assuming $330,000 into this annuity. We're not doing joint annuities. It'd be 160 or whatever it is each.
That mechanic, I think, is kind of a small decision at the end, but there's a reason it's less impactful.
$166.50, yeah.
In this is the reversionary benefit.
Yes.
So when you do a reversionary, which is if I pass away, the account holder passes away, it passes to the spouse, they use the younger spouse's date of birth.
Right. Okay. So
it becomes kind of a joint thing. Anyway.
So what I'm saying is there is options where you can set up two separate annuities, one annuity with two people on it with reversionary, because estate planning could enter the chat where this couple, it's a blended family, we actually just want two annuities for 160. But one of them will go back to the estate. The other one we're setting up rides into the sunset.
100%.
I don't know.
Yeah. That's the nuance. And we sort of alluded to it before. This is probably a good advice product. There's so many bits to this that it's probably something you get advice on.
Yeah.
But you're right. There is different ways. I've simplified it. I don't even know who has the super in this instance. We've just got $1 million between the two of them, and we've put the 30% into the annuity. So in this chart, what we're showing is the income on $1 million and minimum drawdown is $55,000, or $50,000 plus the little bit of age pension. They're going to get is $55,000. So if they need $80,000, they're just going to have to take more out of super, and that's okay.
Keep going.
For the annuity, we've got the annuity is $330,000, and the rest is in super. And we can now see, of $333,000, you're getting $24,000 in payments, in income from that product.
Per year.
Per year.
It's guaranteed.
Guaranteed.
Now, my question is, you've assumed no indexation.
Correct.
So that's $24K per year, forever, amen, good night. If someone did want to tick the indexation box, so that increases by inflation or 2.5%, whatever, each year, this day one argument, because remember our comparison with getting insurance and doing all the options and moving all the sliders, if you tick the indexation box, that might reduce to $18,000 per year in year one.
And luckily, I've got that in a later slide, so we can show the exact number.
No.
So we can definitely look at, but you're right. By not taking on the CPI, by not taking on any indexation, they pay you more.
Yes.
But in 10 years, you're getting less.
And that could be okay.
Yeah, correct. So 24 grand though. What's the numbers on that, Glenn? What's $24,099 divided by 333,000?
0.7.
That's 7%.
Oh, sorry, 7%.
Yeah.
Yeah. Sorry.
I think
This is the fourth episode we've recorded today, everyone.
Big kind.
It's now 6:30 p.m.
Yeah, that's why I'm driving, because Glenn took a fatigue nap.
Yeah, so 7.3%.
Yeah, 7.3%. Now, it's not all income. It's part capital, which is why that number's so high. But it's a guaranteed income for life on that original purchase. That's really high. I've seen some high numbers. This is...
And I think we should potentially say elephant in the room. Are we paying tax on that?
Good question. So if it comes from super money, no. If it comes from non-super money, i.e. you've put all your money you can in super, you've got some leftover inheritance or whatever it might be, the way it's worked out is the income portion of that payment is taxable, but the capital you're returned is not. And that is a calculation that uses life tables and changes by year. So you'll get a statement from Centrelink telling you how much is taxable. And that number as well that I'm quoting here is specifically for a 67-year-old woman. If you're 68, it's a different number. If you're 65, it's a different number.
So what you're telling me here, bro, is by putting 300 grand in an annuity, we've got more money year on year.
You are taking...
As opposed, well, no, because we're depleting capital.
We're still depleting capital.
Okay.
Yeah, so it's misleading in that light, right? And it's good to highlight that. It's not a dividend. It's not interest. Some of it is capital. You could do the exact same thing. I could just change the numbers on the other side.
But that income of 55,759 from super, that is also depleting the super capital.
Correct.
Yes.
Yeah. I think the real win in this is actually what's 16,149. Oh, yeah, pass it over to me.
I'm not using any
driving the calculator as
mechanical
well.
stuff today. I'm ready to finish this up and go get dinner with you.
You're getting 10,400 more in pension, which is about $400 a fortnight.
Because there's that portion of the 330,000 that is not seen by Centrelink as an asset.
Correct.
Yeah.
They only take 2/3 of that value. So that uplift, that is an uplift. Because you need to take less out of your super
And
now.
you've effectively got no market risk of that 300,000. You don't have to worry about the bucket strategy and all that. Sure, there is a risk in the background that your annuity provider is around in 30 years. But in Australia, these funds, they're such highly regulated things, and I don't know any annuity providers that have gone under in Australia.
I can't recall. There's not many that are.
No, I mean,
operating
Challenger
either.
is one of the names in town. CommInsure used to do them, but I don't
They
know.
just got out of it, I think. But they still honour the annuities.
Yes.
Like I think someone else.
I mean,
owns them.
to be frank, everyone, I think Challenger should sponsor Retire Right, because this is the best kept secret. I approached them a couple of years ago. I'm like, do you want to sponsor the podcast? Nah, not interested. I think they need to get the word out more. as in terms of annuity providers do, whether it's Challenger or whoever else. Because in the background, the reason why you can have confidence, you choose an annuity provider who has been around a very, 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 very long time. If they survive the GFC, if they survive COVID, you're probably all good. And in the background, they are investing the money, and there is a high level of regulation for them to invest that money. Now, there was talk as well in the Grattan thing about the Australian government providing the actual annuity.
Interesting.
Yeah, so
it's the underwriting part, which is a fear in these, right?
I'm maybe not opposed to, because at the end of the day, give me an annuity. Don't care who's funding it.
Think about the government guarantee on your cash, the 250 guarantee.
Yeah.
That changed people's mindsets about security. Committing money to an annuity provider, if you go through your super fund and they have a new fancy one or something, it's like, well, then am I stuck with that super fund? Is that super fund going to be around? Will they honour it? I mean, they have to. But there is that, it's in the back of your mind. I'm not going to put all my money in because, and that I think that's the government backing it, even if they don't, they like underwriting the underwriter, could relinquish some of that.
So show me this next sexy slide. What do we got here? Talk to me.
This is the next question as to like, well, am I better off?
Nathan will try and describe it as best as he can to those who are driving their car at the moment and not watching on YouTube.
Yeah. So what this chart shows with lots of different colours is what this couple's asset position is over time and what it would be over time if they didn't do the annuity.
Right.
That's what we're looking at here. So it's for those driving, it's a downward sloping thing. They're drawing down on their assets. They're slowly depleting their super balances. In this case, we've said they need $80,000. They get $1 million of super and they need $80,000 to live on. In the annuity case, that would be made up of $45,000 from the account-based pension, $18,000 from the annuity, and $16,000 from the age pension.
Yeah, so it shows the 3 layers of income.
Yeah. And slightly different calculations just because of some of the different calculator, but the premise is the same. What we can see on the chart is, I suppose there's a concern that if I'm locking this money up, does my estate get it back? Do my kids get to inherit it? I don't want to do it because I want to make sure that the estate's left over or I don't run out of money. What we actually see in reality is because we use less of our own money to pay for life, we actually end up keeping more of it long term, but that changes over time. So initially, it's about the same. There's a first period that you get more back if you pass away, and that's because there's a death benefit in the calculation. And then there's a period where it's around the same, and then there's a period where you actually end up getting more back again if you use the annuity for these people. And I just want to keep highlighting that. Broadly speaking, there is a strong case for people who have got between $600 and $1.1 million that they should consider these, but they're not for everyone.
So based on this slide here, and particularly to verbally say it, when would they run out of money not using an annuity?
It looks like age 99, 98 with my eyes from this distance.
Yes. So call it 100, rounding. And if they use the annuity, it would keep going past 100.
It goes past 105.
I mean, this person, let's be honest, they don't have a problem regardless. No. It's more of an optimization thing.
Correct.
And a lot of you will, and I do see comments, everyone, and I do read the comments in the Facebook group and on the YouTube comments, you need to do more about renting only or singles or couples. And these high amounts of $1 million, the only reason that we really use the $1 million here is it's a big round number and we can really show the benefit with big chunky numbers.
And it's easy math.
And it's just easier. And that's why everyone's situation is different. And you might have $500,000. You might go and get advice and it's worth it for you in terms of advice for you to put 400 in an annuity and keep 100 out. So I want to call out that, yes, I know $1 million, not everyone has $1 million between 2 people or $1 million each, but it's just a really nice round number to use for mass examples.
Yeah. And to that point, providing you're on a part pension, the amount you put in differs, but if you're on a part pension, you're going to get that Centrelink uplift. That's really the advantage for the kind of strategy we're talking about here. I just wanted to cover off on quickly your point about changes to payments and some of the features. And this is more illustrative. They're really product dependent. And with the super funds coming into the market and trying to innovate in this space, we're going to see all sorts of weird and wonderful things. But in this example with this quote, that no indexation option that doesn't increase every year with CPI, you get about 24 grand. If you put CPI on it, that goes down to 18,700.
I was almost
pretty close.
Pretty close. And I haven't not seen these slides. I'm just seeing them the first time here. But because I knew that would be quite significant because they've got to bake in CPI increases for maybe 20 years.
Well, for lifetime.
Or lifetime.
Because if inflation was 4% a year every single year, it would take 14 years for the CPI option to catch up to the non-CPI option. And that's just on the payment. In terms of the total amount of money you got back, it's closer to 24 years. So there's a good argument here to say, well, more money up front and I'll use more of my super later and I'm going to get some extra payments earlier. Maybe I don't need as much income later, whatever it might be. There's trade-offs with everything. Some of them are adjust with cash rates. Some of them attach themselves to investment returns. Not going to get in the details, but there's so many features like there is with the different insurance products. The point is they can get a little complicated, but they can be indexed.
Okay, bringing it all home, who do they help and what are some of the potential downsides that need to be considered?
Yeah. I'm going to fly through some of these and I think people in your Facebook group will probably ask some more questions and details on them. But there is a range of reasons you might do it and we've just talked about, you'd argue, the sweet spot where it's just about optimizing a situation. They can really serve conservative investors. If you just don't want the market risk, guaranteed income is great, or what we call income flooring. Let's say you need $50,000 to live and the age pension's 30 for you as a single and you can put 300 grand in to get 20 grand back for the rest of your life. It gives you a bit of a security piece. Sometimes people use those for like medical fees and things. We know we've got a high medical fee bill. Let's put a bunch of money into this and that's done. And quite a few high-income non-Centrelink recipients use these kind of products for that. I also think there's an interesting argument to say that 7% effective return could form part of your portfolio. It could form part of your income bucket, especially where rates are at the moment. If you've got a diversified asset pool, this can just be one of the different, as you said, levers we have to provide income. And this gives you that security. So that's kind of the broad brush of the different ways you can use it. It's very circumstantial.
Cool.
And obviously there's downsides.
Yeah, what are they?
You flagged the provider risk, and I think that's important, and this complexity risk. Sometimes they just do weird things, and you're like, I don't know what's going on there. And people do fear this liquidity piece. I can't get the money out. You can close them, but there's a cost to do so. I think that's more of a behavioral thing. Or there's just, I don't want to do it. I'm going to one account. I'm going to keep it simple. I think that's a big one. And the last one's just timing. You get in the wrong time, you're going to get a slightly worse payment. You get in the right time, you get a better payment. And that changes week to week.
Have you ever seen potentially as part of strategies that we might set up? Because I remember when I used to set up like term deposits for people on wrap accounts or whatever, and they're like, yeah, we've got 500 grand and we needed to keep that on term deposits. I wouldn't just put 500 grand in one term deposit. I'd usually split it up just to hedge the risk that, all right, well, we're not going to do 500, we're going to do a 300 and two 100s. So if something happens throughout the next 12 months, we can exit 100 grand one term deposit and not forego any of the interest in the other ones. Would there be a world where we potentially have two annuities or do one this year and then in a year's time we've got an inheritance coming, we'll do another one? Like, are we layering annuities?
I've seen that.
Yeah.
Yeah. Layering, you might do it because you're doing a large lump sum and just in case you need to break it, it might have a cost. Let's do 100 and 400 or something. So that, Or you could do one on an RBA-linked option and one on no CPI. It gives you a little half-half.
Yeah.
You can
So it's not all or nothing.
Yeah, exactly.
Yeah. Any other final comments around this annuity thing?
I feel like a little bit of an annuity shield today. Like I'm pumping them up.
Yeah.
And I think the key to this is any clients that come and see me where they've got somewhere between 600 and 1.2 mil worth of assets, I'm going to look at these no matter what.
Yeah, it will enter the chat. Whether they're used or not, they will be considered.
You should understand the option that was available, and then you can discount it. And so anyone in that situation, I would encourage it. It doesn't mean they're for you. They can be great. You don't necessarily need
In the so my book here, The Quick Start Guide to Investing, everyone, it's won a couple of awards last year. Go grab yourself a copy if you want to learn about investing. In this book, I talk about 6 ways to own investments in Australia, like ownership structures. And one of them is an investment bond, old school name insurance bond, but there's no insurance policies in there. And I say for an investor who isn't potentially at retirement planning, the investment bond pendulum will swing the most in terms of really, really, really good for someone and suits, or really, really, really not good. It's not just a, yeah, maybe. And I think for annuities, it's the retirement product option where the pendulum will swing really, really good, this suits your needs, or really, really bad, this ain't it.
100%.
So that's why it's just really handy to understand that this is another tool in your retirement tool belt.
Yeah. Spot on. You're 100% spot on. There's different reasons to take them out.
Yeah.
And those reasons are
And the reason I say that is with the investment bond thing, in all the Facebook groups, there is so much like hate for investment bonds. Like, don't do that, don't do that. Hey, bro, just because it's not suiting for you doesn't mean that it's not going to be perfect for someone else. I've got 4 investment bonds, one for myself, one for my niece, and one each for my 2 nephews. Me, the pendulum swings perfectly. 8% after fees and taxes over the last 10 years. I'll take that. Pretty good. What's the problem? Really suits me really good. Oh, don't ever use it. No, shut up. It's because it didn't work for you doesn't mean it might not work for someone else.
Yeah.
And that's the same as these things.
I talk to my advice process I call consultative, and a big part of that is walking through like learning about someone, and then the step towards advice, or the step in between, is let's look at the different options that you have, whether or not we discount them so that you understand them. And I jokingly call it like uncle-proofing your advice. So if you're at that family barbecue and Baz comes over to you and he's like, Glenn, what you should do? You shouldn't use an insurance bond. You should do this.
Yeah, you should shut up, Baz.
And you're like, well, Baz, thanks. I'd considered it.
Yeah.
You should get an annuity. Well, actually, we spoke to our advisor. They showed us what it looked like. We understood our options, and we could move forward knowing what our options were, informed. Yeah. We're not you. And I think there are different reasons that aren't always financial.
We get it. We understood how it worked. It even was recommended to us, but we either just put 50% of the recommendation into it for whatever reason, or we didn't do it. It's okay. Not everything is for everyone.
Exactly.
Nor should it be. So there we have it. Investment bonds. No, it's not investment bonds. Whoa, long life, everyone. Long day. Annuities. And we probably will do another episode on investment bonds, a deep dive, just for the lols. But thank you so much for watching today. Nathan Fradley from nathanfradley.com.au. If you think Nathan might be able to help you, who do you deal with, Nathan, in terms of clients?
Broadly speaking, the emotionally and technically complex. So
which often can have highest amounts of wealth.
Higher amounts of wealth or higher amounts of complexity, because my fees are generally going to be higher than other advisors, because I'm spending more of my time on harder things and I work with less clients at any given time.
Yeah, so he doesn't have 10 meetings a week and 4 a day or whatever that is. It's very much, in the weeds, complex, emotionally charged. But if you do need advice, head to retireright.com.au, click get help. look, if you're like, hey, I really like Nathan, can you recommend him to me? I'll have a look at it. And if I see that, oh, wow, there's some aged care stuff or a divorce or some family dynamics, I'll 100% introduce you. But if I don't introduce you and you've talked about Nathan, it's just because I know it's not going to be the right fit and it's going to save you and Nathan a lot of unnecessarily used time to get to that conclusion. Thank you so much for joining us again today, Nathan. We'll see you next time. Remember, you only retire once, so...
retire right.
Yes. All right, bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.